Okay, so these are your review terms. I would assume that you would know by now: raw material, direct labor, manufacturing overhead, work in process, finished goods, cost of goods manufactured, as well as cost of goods sold, which we've covered. So we'll start here. Okay, so this shows you that direct material, direct labor, and manufacturing overhead can be applied to the individual jobs. So direct material and direct labor are applied to the individual jobs as they occur, and then the manufacturing overhead jobs, or the manufacturing overhead, is applied at the end of the period, as shown here. Okay, so So obviously you know now how to estimate the predetermined overhead rate. That's the POHR that you see right here. And it is always divided by the cost driver, which you will always be provided. It's typically direct labor or manufacturing overhead. So you'll take the total estimated manufacturing costs, those will also be given to you, and divide that by your cost driver, whatever your cost driver is that they tell you. That includes both the fixed and the variable portions of the estimated overhead. Okay, so this is where life gets kind of fun. So the idea here is that the material purchases, the direct labor, and manufacturing overhead all go into this account called work in process. These are all inventory accounts found on the balance sheet, but the purchases, you can see the labor and the manufacturing overhead go into this work in process as they're being processed. And then, of course, once they are finished, they moved into another balance sheet inventory account called finished goods. Once they are sold, they move on to the cost of goods sold for those items that are sold. So this is just a general flow of how the costs work. I think that's important for you. All right, so you can see that as things are incurred, then they move. So a material purchase comes into raw materials, but then as it gets used, any of the indirect portion of the raw materials would go into a manufacturing overhead applied or actual account. Now, one thing I want you to notice here is that under manufacturing overhead, I usually create a T account. I like this as an example because the actual manufacturing overhead, right, those things that are actually incurred go on the left-hand side. Those manufacturing overhead items that are applied once the jobs are complete appear on here. So that's going to be really important for you to keep straight in your head as you go to figure out what is over-applied versus under-applied manufacturing overhead, and you'll see that. Okay, so next slide. So here you can see that the direct materials will go directly into the work in process, whereas those indirect materials, screws, glue, what have you, go into the manufacturing overhead. Okay, this is all going to make sense to you. Okay, same thing with wages, right? So the direct wages, like the factory workers and that type of thing, that direct labor will go into that same work in process account, whereas the indirect labor will go in, do you see that, under the manufacturing overhead right here? Okay. And then you can see as manufacturing overhead gets applied, the amount based on the predetermined overhead rate is a credit, which goes as a debit into the work in process account. Okay? So, and as I mentioned before, as a job is completed, it goes from the work in process account, which included, based on the previous entries, the direct material, direct labor, plus that amount of manufacturing overhead that was applied based on the cost driver and the estimated manufacturing overhead. Okay, it becomes a credit, so that amount for that job becomes a credit and moves over to the finished goods as it gets finished. And that kind of makes sense if you think about it. A car that's being manufactured is either in process or it's done. So once it's done, then it moves from being in process to being done. Okay, so this is kind of the overview. Once it goes into process, all of those things that go into making the car, for example, would go from, go into the work in process. Once they're completed, they come out as a cost of goods manufactured into the finished goods. Once they are sold, they move out of finished goods into the cost of goods sold. So I particularly like this slide because it overviews all of that. Review. Okay, and that is, again, just another example. However, now we've included the selling and administrative, which never gets included up in here because this part right here is the manufacturing costs, and this part down here are what are called the period costs, selling and administrative, never included in the manufacturing costs, which you probably know by now. Okay, now this is the tricky part, is that the manufacturing overhead, again, as I pointed out before, the actual material, indirect material, labor, and other overhead, just various things, which will be given to you, will be listed at the actual price on the left-hand side, which is your debit. As they get applied, they move out as overhead that's been applied into another account. But then the balance is what we're going to look at next. $10 that was actual, that came in as manufacturing overhead. Of course, on previous slides, you know that this consists of indirect material, indirect labor, and other random manufacturing overhead. All right, that was all totaled up. And at the end of the month, it totaled, I just gave you some figures here, $680,000. But the amount that was applied based on the overhead, the predetermined overhead rate times how much was actually used. Say if it was based on machine hours, then this was based on the predetermined overhead rate times the actual amount of hours, and so that's how the applied came about. You can see that these two numbers are not the same. There's more over here, which means there's a balance in the actual overhead, and you can just see here that there's less here, so more needs to be applied, right? You get that? Okay, let's look at this example. In this case, the numbers are switched, and there was actually only $650,000 in costs that were actually incurred under manufacturing overhead. But there was $680,000 that was applied, so you can see just by your very own eyes that there's actually too much that was applied. So it was what we call over-applied. All right, so now what do we do with that $30,000? It can either be, whether it's under-applied or over-applied, it can be allocated to the different accounts where it originated from, which was work in process, cost of goods sold, and finished goods, or it can be closed out directly to the cost of goods sold. If you think about it, the origination of the cost of goods sold was from the finished goods. Where finished goods came from was the work in process. So this basically distributes it over all of them, or it just closes it out directly to the work in process. In the case where the overhead was over applied, meaning that we had applied too much manufacturing overhead, we're simply going to adjust that by taking it out of the cost of goods sold. So here we're going to take that out of the cost of goods sold. I think this is an important slide because you can see that if manufacturing overhead was under-applied, meaning that applied overhead is less than actual over-applied, we need to apply more overhead, then we can simply increase the cost of goods sold, which inevitably will reduce net income, right? More expenses, less net income. On the other hand, if the manufacturing overhead was over-applied, that means we incurred too many expenses. Cost of goods sold is an expense. So we're going to decrease the amount of cost of goods sold, which will increase the net income. And this is really the one that I want you to focus on. This just shows you that I had a certain amount of unadjusted cost of goods sold. Then I take into account either my under-applied or overhead, or under-applied overhead or over-applied overhead into account to make an adjusted cost of goods sold, and that's what's going to ultimately go on my net income. So here you can see this is basic financial accounting, that I took my sales, whatever my sales were, here's the cost of goods sold, and now we know a lot more about the origination of this cost of goods sold to come up with a gross margin. Then of course we take our administrative and selling expenses to come up with our net income. So you will be asked to do something similar to this, but you already know how to do that. And the final thing is that service companies are no different. It's just that you don't base it on necessarily direct labor hours or manufacturing hours. Since there is no such thing, it's usually based on more of a job. So it's more on the direct labor. That's all I wanted to point out there. Okay, that should do it for this.